by introducing yourself, Ryan, and yeah, your expertise?
Yeah, my name is Ryan. I'm a real estate investor, also a real estate CPA. I've started my real estate CPA practice about 4 years ago. At least been full time for the last 4 years. We help real estate investors across the country, mainly short-term rental investors, save money on taxes, help them set themselves up for success when it comes to lending too. I think a lot of investors get stuck because they max out their debt to income too quickly. Because they buy a lot of properties in their personal names or conventional loans. And so we help people scale quicker if that's their goal, or kind of, stay where they're at if that's what they please also, and just pay a little bit less in taxes.
Awesome. Um, all right. Yeah, looks like Bella is looking for general tax prep for short-term rental properties, hoping to acquire one this year. Um, so I think we can go ahead and hop in. If you have that document you want to share, Ryan, or yeah, is your what you're covering today targeted towards folks who are already own short-term rentals? Can you speak to investor position as well?
Probably people who already own short-term rentals. This is
Okay.
probably going to be really helpful with. But to answer Bella's question, um, if you're looking to acquire one this year, is there any way I can pop the question up? I don't think so.
It looks like it just got sent to me. Yeah, it just says, there we go. Yep. All right. I'll
Yeah.
start. I'll make sure to drop any further future questions in the chat so everyone can see.
I would say the biggest thing when you're buying a property, if it's your first property or it's your fifth property, doesn't matter. The number one most important thing to think about is how are you going to keep track of everything? So ideally, you want to have like a separate bank account that's not your personal bank account, to understand like, okay, here's all the money that I made, here's all the expenses that went into the property, and just having a separate bank account is easy to be able to track that. I I would say also too, if you're a high income earner and you're especially if you're buying like a 400 $500,000 plus property, like where you buy the property is super important, Bella, because you want to try to avoid areas that have really high land value, like beach market or California, a city market, because you'll get less than tax benefits. Because you're not able to depreciate or write off land. And so for our like high income earner clients who are buying big properties, like that's a pretty important thing. Like I had a client one time that bought a $500,000 property in Tennessee in the Smokies. She saved like $40,000 in taxes, and then she went and bought another property in Gulf Shores a year later and saved like a third of that amount. And it was because in Gulf Shores, if you own a home in Gulf Shores, like the land is worth so much money anywhere on the beach. And so you don't get as much tax benefits. So if that's something that's important to you, like one of the things that I would do when I'm like researching, analyzing markets is you actually can go on the county assessor website of wherever you're going to buy a property and see what the breakout between building and land is. And so it'll give you a better idea of how much you can expect to save in taxes because you'll have the breakout of building and land. I mean, I can generally tell you like low land areas, mostly the Midwest, mountain markets have low land, but your high land areas where you try to want to avoid for tax purposes are like beach markets, city markets, uh, California in general, especially closer to the beach in California, like the land is super high. And so those are probably the best tips that I have for uh, people looking to acquire properties, if that helps.
Awesome. All right. That looks like all the questions that have been submitted so far. Thanks, Bella. So if you want to hop into your document, feel free.
Okay. I'm gonna see if I can upload this to the Zoom too. Let me see. It's gonna put it in host and panelist. Oh no, maybe not. It won't do anything. I'll have to share it after the call.
No problem. I'll make sure we'll send out a webinar follow-up with the recording for this and any materials that you go over today. We'll make sure to send it to all participants afterwards.
Yeah. Okay. So when it comes to like preparing your tax return, especially if you've never prepared a return or never have had a rental property before, it can seem like overwhelming because all these documents that you have to get, all these different things that you need to have for tax time, because more information is better. And likely the less documents that you have just means the more money in taxes that you're paying because you're missing out on deductions, important information, things like that. But just as a high level general documents, like this is pretty much a checklist that we use for clients that we're preparing the returns. Like you want to have your prior year individual tax returns and business returns ready at your disposal. That's really important because it allows us as like tax reviewers to know whether or not something significantly changed or not. Like if your W-2 income was super high one year and it's not the year after, or maybe you took out retirement distributions, like it's a really good way for us to know that because we can review your prior year returns. Of course, you're going to have your ID handy with like your birth date, uh, proof of that you're actually a real person, some healthcare documents, like if you guys have healthcare through your employer, or if you're on the marketplace, you'll get these various healthcare documents that you kind of need to put together, like a 1095A, 1095B, 1095C. Your W-2s, of course, you want to have those handy. The If you went to the casino and you made a lot of money, you're going to have a W-2 from gambling winnings. These are all the various 1099s that somebody can have on their tax return. So, like if you have a bank account, you're going to get a 1099 interest. If you have a stock account, you're going to get dividends. And some of these are also inclusive of like Airbnb itself. So, like a 1099K, for example, you get from Airbnb if you have, I believe the rule is $20,000 in revenue and 200 transactions. Okay. So you have to actually have both. You can't just have 20,000 in revenue or 200 transactions. You have to have both. So if you don't get a 1099 from Airbnb, it's likely because you didn't pass those two tests, which is fine because you shouldn't necessarily rely on Airbnb's 1099 for your reporting because it's likely to kind of be incomplete. For example, like it might show the gross rent that you receive, but it doesn't show the amount that they deducted for occupancy taxes, cleaning fees, etc. And so that's why like keeping good track of your books and records and not relying on the 1099 is probably a smart idea. If you have any K1s from partnerships, S corporations, maybe you're a member of a trust, you'd get a K1 for that. I'll talk a little bit more about this later on when it comes to owning properties with other people. These are all the deductions that you get that are personal deductions. So if you have a mortgage interest on your primary, if you have a property tax bill on your primary, if you have charitable contributions, auto registration fees, medical expenses, like those are all things that you want to keep track of and see if you're able to deduct those on your taxes. Here's another, here's some other various sort of deductions too on a personal side. Like if you have student loan interest, let's say you put a kid through college, you're going to get a tuition statement. Uh, if you're a teacher, actually, they allow, I believe it's $500 a year of educator expenses, HSAs, IRAs, and then moving expenses, you're only able to deduct if you're active duty military. Cryptocurrency, right? If you have a Coinbase account or a Kraken account or some type of platform there. Now, this kind of moves on to more of the business side of things, like on your business return. So, if you're a self-employed person, like whether you walk dogs, you might manage other people's Airbnbs, but not own your own Airbnb. Like if you're a cleaner, if you're a handyman, if you're pretty much any sort of like small business activity is going to file on the Schedule C as in Charlie. And then these are the sort of the miscellaneous forms you're going to want to have for that. So you're going to want to have a profit and loss statement for that that tracks your revenue and expenses. That's why I mentioned it's really easy to set up a separate bank account for that. So you can link it. You can link it to like a Stessa or QuickBooks and keep track of your income and your expenses. You'll likely get 1099s if you're self-employed from your contractors or vendors, whoever you work with. One thing too that a lot of people don't know about is even if you don't have an LLC, like let's say you started a side hustle or a small business, you took on managing people's properties, you may not need an LLC, but you still can get an EIN letter. And so that can be done within 10 minutes on the IRS website. But the reason why you would do this as opposed to not is if you don't have an EIN letter or an EIN number, well, then you have to use your social security number for everything. Like you have to give Airbnb your social security number. You have to give uh, your people who are paying you money your social security number. You have to give your vendors and your contractors like your social security number. So we always use EINs, which are, IRS issued identification numbers, so that way we don't have to give out our real social security number because you don't really know who in the world is going to have access to that. Now, if you have an LLC, and this is non-real estate related, but if you have an LLC, like here's all the different documents that you may or may not need if you're going to have an LLC. So you have your articles of organization. That's just the paperwork that you get from the state when you form your LLC. You're going to have that EIN number. You're likely going to have a profit and loss. You want to have a balance sheet, which is a balance sheet is simply just how much is the business worth, like how many properties, what is the fair market value of the properties, what's the cash in the bank account, do you have any loans, like all that kind of goes on a balance sheet. Now, real estate specific, and what you can almost use this as is like a little checklist of here's all the items that I think I need to have in order to file my tax return. But if we're moving on to short-term rental specifically, like you want to have you want to have your appraisal somewhere, right? Why is the appraisal important? Well, the appraisal has sometimes they include the land. And then that for tax purposes is what we can use to determine how much money you can save in taxes by buying that property. If you did a 1031 exchange to buy your first Airbnb or to buy your second Airbnb, you would want to have your 1031 exchange paperwork. If you had a mortgage on your property, because not everybody buys properties in cash, you would want to have your 1098 from the bank, your mortgage interest statement. If you met that threshold for the revenue and the expenses, I'm sorry, the revenue and the transactions, you would get a 1099-K from Airbnb or Verbo. Closing disclosure or settlement statement, these are called different things in different states, but it's pretty much the paperwork that you get when you close on a property. This is very important because for record keeping, it's very important, but also for tax purposes, when you close on a property, there's some things that you're able to deduct, excuse me, right away versus there's some things that you have to amortize over time. So anything that's like a prepaid on a closing disclosure or settlement statement, like prepaid interest, prepaid taxes, prepaid HOA fees, prepaid, um, I think I covered most of them. Like those, you actually get to deduct on your tax return in the year that you pay them. And this is probably one of the most common missed deductions that we see for clients who maybe did their taxes themselves or like went to a CPA or an accounting firm that wasn't really specialized in real estate. And I mean, everybody knows like your closing costs can add up. So typically your closing costs are going to be three to 4% of the purchase price. So if you're buying a $500,000 property, it's not unlikely for your closing cost to be $15,000. Well, if you don't have a good accountant or you don't know that they need, your accountant should be asking you for your closing disclosure, because there's going to be some fee, some of that $15,000 in fees you're going to be able to deduct, right? Versus, I mean, we've seen people just completely miss out on those deductions. If you did a cost segregation study, you're going to want to have a copy of that cost segregation report. Property tax bill, that's important too. So the way that property taxes work for income tax purposes is it's based on the year that you either paid the tax bill or when it got released from escrow. Like say you escrowed your property taxes, um, when that amount of money releases from escrow, that's when you get to deduct it on your tax return. And then a profit and loss statement, EIN, if applicable, your LLC information for that short-term rental, because maybe you bought your short-term rental under an LLC for anonymity and asset protection. And then lastly, if you're going to implement anything like the short-term rental loophole, or if you really want to maximize the losses and deductions that you get on your Airbnb properties, you're going to want to have what's called a material participation time log. So we have Excel files for this, so you can track your time in Excel. There's other apps out there called Reps Tracker. I have a lot of clients recently that have been using this thing called Toggle, which is supposed to be like an app on the phone that makes it really easy to time track. But you think about all the time and effort that goes into like managing a short-term rental, it's very easy to hit the amount of hours that are required in order to have a good material participation time log. So you're communicating with guests, you're obviously fixing up the property, you're communicating with cleaners, things like that. Like there's a lot of work that goes into that.
Brian, we actually have a question on material participation.
Mm.
If I take the depreciation under material participation, will I have to pay later in capital gains? It's a question from Robert.
We'll be sure to co oh, sorry. If I take the depreciation, will I have to pay later? So yes and no, I would say, and here's why. I can kind of like mind map this out for you. So year one, let's say for example, year one, you know, bought the property, furnished the property, hit your hours for material participation. And then let's just say your total loss on that property that year was 100,000. And let's say you were in a 30% tax bracket. So you save $30,000 in year one. Okay. So that's taxes saved. And so yes, when you do sell the property, you have to recapture the depreciation. But the way that it works is you're recapturing the depreciation based on what that furniture, cabinets, flooring, everything inside of the house is worth in the year that you sell it. So basically the longer you hold on to the property, the less that you have to pay back because those items are not worth as much anymore. It's very similar to like if you when people buy cars and they deduct them in their business. Like if I bought a $50,000 car and wrote it off in the first year and then sold it 4 years later and it was only worth 25,000, like I only recapture up to the value of what it was worth when I sold it. So like in this example, let's say in year five, you sell the property. Well, you can't say it's zero recapture. I mean, arguably, if the new owner comes in and throws out everything and replaces everything, it is zero. But generally, after 5 years, you're normally only recapturing about half of what you took in the first year. And so then now you're only recapturing that 50,000 in depreciation at that 30% tax bracket. So then the taxes that you pay back is only 15,000, which is half of what you borrowed in year one, right? So there's no other place on the planet where this maths. Like if you go and borrow $30,000 from a bank and you only pay them back 15,000 in 5 years, like you're probably going to get sued or they're probably going to come after you, right? The IRS is the only place where you get this deal, basically, where you can essentially borrow money year one, pay it back year five, and the amount of money that you pay back is less, right? Because of how depreciation recapture works. So pretty much the longer you hold on to the property, the less you have to pay back. And from experience too, uh, but wait, there's more, like the OxyClean guy on the TV, right? That's also assuming that you're in the same tax bracket in year five. So like with a lot of our clients who are buying, one property, maybe two properties a year, that they're going from this 30% bracket because they're high W-2 income, they want to buy real estate, they want to pivot into real estate. Like I have clients, Jen and Ross, who like they were making 300 to 400,000 at their W-2s. They started buying real estate. 4 or 5 years later, they're making the same amount of money that they were making at their W-2 jobs without the W-2s because they're full-time in real estate and they have 5 or 6 properties now. So their tax rate is a lot lower than what it was when they originally started. And so your tax rate, that's sort of one of the unknowns when you're thinking about doing this is like, what's my tax rate going to be in the future? Well, if you're not working as much because you have properties and those properties are giving you income, well, maybe your tax bracket in year five is only 20%, so 30%. And now you're only paying $10,000 back instead of 30,000, right? So there's all these different variables that go into that, but this is sort of a hopefully a good explanation of how that works. So like, you know, there's really only one way to mess this up, guys, and it's to, buy a property and sell it within a year or two. That's because then you basically aren't getting the power of time value of money. I think the other way to mess this up is if for whatever reason, like I've had a few cases, it's normally not the norm, but I've had a few cases where like a client gets laid off at the beginning of the year, or they're just not in a high tax bracket that year, but they bought a lot of real estate. Either they inherited it or they just closed on a bunch of properties one year. Like you don't want to be taking depreciation when you're in like a low tax bracket for you, because when you go to, especially when you go to sell the property, if you're back to making that W-2 income or you're back to being in a high tax bracket, well, now you might have borrowed $100,000 and it only saved you 12 to 15% in taxes. So then you only save 15 grand. And then when you sell the property in year two, let's say you were back up in that 30% tax bracket. So now the actual taxes that you're paying back are more than what you borrowed. Like that's the only way, really way to mess this up. Um, is that helpful?
Yeah, I got a chat saying thanks for the explanation.
Yeah. Yeah, like I said, there's that's the only two way like that's the only way to mess this up is take the depreciation in a year where you're in a low tax bracket and then you have to like you're forced to sell the property in year two, year three. Obviously, nobody buys a property if they know that they would have to get rid of it or sell it, but things happen. People buy properties in HOAs, and then the HOA laws change, or the sentiment for short-term rentals. So that's why it's really important if you're buying properties. Um, I would say in like non-tried and true vacation rental markets. So like your Smokies, your Destins, your 30As, your um, places that have had vacation rental markets forever, that their local economy depends on the tourism, like you're probably fine. But if you're going to buy in an area um, that's, I would say, like unproven, you really want to be checking like, well, hey, what's the sentiment towards short-term rentals? Um, and the one good way to know that is like board meetings, lobby meetings. HOA board meetings, and you really get an understanding of like, are these people pro short-term rental or against short-term rental? Um, so I'll give you an example. Like I bought so I've been fishing in Ohio in Lake Erie, like literally on Lake Erie for 10 years plus. It was always a place that we went to, me and my dad. And then I'm like, I'm gonna start buying some short-term rentals here because I can rent them out for good money when I'm not using them, and then I can also use them when I travel to go fish there. Um, and the as soon as I started buying them, the sentiment for short-term rentals started changing. And because you're literally buying a house in the middle of every where other people are actually living. Like people are living their day-to-day lives on the same street where there's a short-term rental. Some people don't like that, especially older people. Um, so I remember like getting the cops called, like this lady that lived next door would always call the cops, always complaining. I remember one time um, the cops would call me before they were coming out there. That's how crazy it got. They're like, "Hey Ryan, we're coming out. We just have to. It's part of protocol." And then I see on my camera in my backyard, the cops are having beers and playing bags with the guests in the backyard. Like they weren't doing anything wrong. Um, but the reason why I was so confident that it was going to work out in the end is the mayor of that town had short-term rentals. So he would never sign off or pass or approve laws that would ban short-term rentals because then he would have to um, not rent out his properties anymore. And so like understanding the sentiment of where you're buying is I think is pretty important. Um, that helpful? Better explanation? Yeah.
Yeah, I think that covers, let's see. Yep, we got sent in the chat. That's helpful. Um, yep, I'll let you know if any other questions come up, but we can proceed.
I I would say another thing, Robert, too, is your for anybody that's I basically call it a shock and income year where you got a retirement distribution or you got a big bonus at work or I mean we've had clients who had company stock and their companies merged or whatever. Like anytime you have a shock and income year, like I call it, where your income is either super high one year or it's lower for the course, like that's when tax planning is pretty important. Because if I had a super low income year, maybe I don't want to take bonus depreciation on that property because I'm not going to save as much because my tax rate's already lower for whatever reason, right? If I'm in a super high income year, I definitely do want to take bonus depreciation because I'll get it at that higher percentage and it'll save me money. Um, but one thing I would say, and I don't know if this applies to anybody, but you also want to be careful if you buy multiple properties in the same year. Okay, multiple properties in the same year. Why? Well, it's the more properties that you buy in a year, there's a decreasing marginal return on your tax savings. So for example, like let's say I bought two $500,000 properties in one year, and each of those properties gave me $100,000 in depreciation. And let's say, for example, uh, for purposes of this, let's say I was single, making $250,000 a year. So I'm right in here at a 32% bracket. I'm making 250 grand single. So when I do the cost segregation on that first Airbnb, I'm getting that benefit at 50,000 multiplied by 32%. And then the next 50K I'm getting at 24% because my tax bracket's sliding down, right? So then if I was to do another cost segregation, if I was to add that second study on there, well now my income's going from 150 down to 100, and I'm actually going to dip into the 22% tax bracket, right? So I'm always trying to time like how can you save the most amount of money over the course of your life, not necessarily just 1 year. And so if you're anytime you buy multiple properties, it's worth doing an analysis to see like, okay, should I actually use both of these this year? Or should I use one and hold off on the other? Because that's another cool thing about this strategy is you don't have to take it in the year that you buy the property. You can delay it into future years. And so in this example, like I would tell our client, hey, just do one because you're in a 32% tax bracket, right? Next year, you're going to be back. Do you expect next year that you're going to be in that same bracket? Yeah, I plan on having the same job or I plan on staying in the same career space, whatever. We're talking about a difference between like getting tax savings at 32% and getting tax savings at 22%. So that's a 10% difference. And on $100,000 of depreciation, 100,000 times 10%, like it literally saves you five figures. Um, it saves you five figures in taxes just by knowing when and how to take the depreciation, right? Uh, it's like Goldilocks and the Three Little Bears. Not too hot, not too cold. It has to be just right. And so you can save so much money just by knowing, hey, I'm in a super high income year this year. Maybe I should take all the depreciation. See, like if somebody was making if somebody was single making 500,000 and they had 200,000 in depreciation, it wouldn't matter because 500 to 300, they're still in that 35% tax bracket. It's just when you're on these borderlines, these tax brackets where, okay, I'm getting benefit at 32%, now it's only 24%, or hey, I'm getting tax benefits at 22%, now it's only at 12%. Like that's when you want to think about potentially not doing both studies in the same year. Hope that's helpful. Hope I didn't just like confuse everybody that's on this call right now. But this is some of the nitty-gritty stuff that we do at our CPA firm. More questions?
Looks like that's it for now. But yeah, if folks have any more questions, feel free to drop them in the chat. Ryan, do you have a recommendation for like filing as an individual versus creating an LLC if you're if you're buying and operating short-term rentals?
Yeah, first I would say to operate as an individual versus an LLC, it starts with uh, you as a person. How high is your net worth? What do you do for a profession on a day to day? So like somebody who's up there in net worth, but they have like a regular W-2 job that doesn't uh, prompt a lot of liability for them. Like they're in tech sales or they're in software or whatever the case is. Like they have a good net worth, but they're not like a high risk, individual. You could probably be fine without an LLC. Um, Now, if I had an MD behind my name and I was a doctor, or I was in construction, or I was in a field that just presented a lot of like liability and risk, I would want to move those assets away out of my name and into an LLC to protect them, to protect myself most importantly. And then, so that's what I call like the net worth slash how risky of you are as a person, sort of gut check. But a mathematical way to go about it would also just be um, how much equity are you going to have in the property itself post close? So this is going to change whether you put down 10%, whether you put down 20. For me, I personally, I will buy stuff in my personal name because I can always close on it the fastest, I can get the best funding and I can get the best terms. But once I hit about 150 grand of equity in the property, I move it out of my name and into an LLC. Like that's just my personal rule because if you have a rental and you're operating a rental out of your personal name, everything that you own personally is liable to a certain extent, right?
Hmm.
So I want to, if I have a high net worth and I'm a, super high risk person, like I want to move that property out of my name and into an LLC once when the time's right. For me, it's like 150,000 of equity in the property.
Okay. And then, but from like a tax savings perspective, like do you have more benefits available to you if you're filing as an individual versus an LLC? Like I understand from an ownership perspective of like, do I want to buy this under an individual versus an LLC? But like from a tax savings perspective, is there any
No,
takeaways?
there's no legit like there's nothing that you cannot deduct by having an LLC versus just operating under your personal name. Um, I would say from like an audit risk slash are you running an actual business versus like a hobby? Because that's the biggest thing that the IRS is on nowadays is like, are these people actually running these, which we are, of course, nobody's buying properties to let them sit there and not make money, but that's probably the biggest thing the IRS is like after is like, are these people buying these as businesses or are they just kind of buying the lake house to have it and they're renting it out a few times so that way they can deduct all their expenses against it? Like,
Hmm.
I think having it in a separate LLC helps you from a uh, how would you put it? Like gut check or the eye test of like, is this person operating a true business? But you get the same deductions in your personal name that you would if you had it in an LLC.
Okay. Got it.
Yeah.
Thanks.
Yeah. But that was about all I wanted to walk through today. The the
Um, okay, we just have a follow-up question from Bella. How about um putting it into an S corp?
okay. So Bella, if you take anything away from the call today, we don't put real estate inside of S corps or C corps. If you own rentals, it should only go inside of you. It should only go in your personal name with really good insurance, or it should go in a single member LLC. Okay. Um, there's a ton of reasons why you don't want to own real estate in S corps. I don't want to bore everybody to death with the details, but long story short is you'll pay more in taxes while you run the property as a rental, as well as when you go to sell it or even refinance the property. Um, so for example, everybody, most people know that when you refinance a property, it's not a taxable event. A refinance of a property is not a taxable event only if it's in your personal name or a single member LLC. When you have real estate inside of an S corp and you refinance, that's that actually shows up as a gain to the S corporation, and you don't want that because you essentially have this fictitious gain on money that you may or may not have received. Right? Like, yeah, you might have refinanced, but it was only to refinance the terms. It wasn't really to pull cash. It wasn't like a true cash out refinance as opposed to a just a rate and term refinance, right? Um, so I hope like just you only want to hold real estate actually three different ways. So personal name with really good insurance, single member LLC if it's just you, or a multi-member LLC taxed as a partnership if you have a partner, like somebody that's going to buy the property with you. I just put that in the chat too. Great
Great.
question. Us corporations definitely have their place. So if you're operating a normal business, if you're a CPA, if you're a doctor, if you're uh, literally anything that a small business owner, self-employed person can be. Plumbers, electricians, real estate agents all the time are S corps. You only use S corps, S as in Sam, corpse. Um, you only use S corps for active business income. Active business income. So like property managers, for example, property manager doesn't own the Airbnb. Property manager just provides a service to the Airbnb owner. Co-hosts don't own the Airbnb. They provide a service to the Airbnb owner. Cleaners, handyman, those types, those types you would have an S corporation if you were doing the service on behalf of somebody else. But if you're the one that actually owns the property, you just want what I just put in there, personal name, single member LLC, or multi-member tax as a partnership. Yeah.
Awesome.
Hmm.
Thanks, Ryan. Yeah, encourage folks to add any additional questions. I guess I have one question for you, Ryan, is especially since we'll be sending this out to everyone who might not have been able to join the live webinar, but do you have recommendations for folks that are, filing for their businesses this year, but perhaps like have incomplete documentation or aren't as organized as maybe they'd like to be? Any kind of tips for approaching tax time in that situation?
I would literally start with the checklist that we're going to give you and just go through and you can put like symbols on it to be like, okay, or maybe you can even print it out and just like cross off everything that you have, or if it's not applicable to you, just cross it out, right? But start there. And the I think what terrifies people the most is that they haven't been like taxes. A lot of times people only worry about it like 2 weeks out of the year or like a month out of the year, rather than being proactive about it and worrying about it, not worrying about it, but like planning for it year round. Because let's be honest, it's like we know it's going to happen, and we still like bury our heads in the sand up until the point where it's like, okay, now we have to deal with it. Um,
Hmm.
even like me, like I sometimes, you know. Like you're supposed to brush your teeth for 2 minutes a day, right? Twice a day for 2 minutes a day. So, and every year you have a cleaning or you have a checkup, right? Well, okay, I'm supposed to brush my teeth 4 minutes a day for 360 days. That's like 1,200 hours. So would I be okay if I just brush my teeth 7 hours in a row the day before I go to the dentist?
Right.
Probably not, right?
Yeah.
But that's how a lot of people are treating bookkeeping, tax preparation, tax planning. You can't just say, "Oh, I'm gonna chalk up a whole day to go and do this," because that's where you will miss documents, and that's where you will miss deductions, and the stuff that you bought last summer to fix up your Airbnb, like you're gonna forget about it. That's why I would recommend like every month just going through like how much did I spend on this per month? Can I easily track it? What did I spend? So that way you're not backtracking 6, 7 months later to try to figure out like what you actually spent on.
Yeah. That makes sense. And Bella had a question. What is the best software for tracking rental expenses or income, or your recommendation for that?
Right now that's free is probably stessa.com. You can link a bank account to it. Um, I don't know exactly what they do because it is free. So like there's always a saying like if it's free, then you're the product and they probably sell your information. But it's probably better than like, QuickBooks, for example. I forget the fee for QuickBooks nowadays, but it's definitely up there. So if you're just starting off, it might make sense to use like a Stessa. Um, I'll give you another like pro hack too, is you probably can get away with if you didn't want to subscribe to any software, um, you can probably get away with having your rental with a separate business account that tracks all the revenue and the expenses. And you have a bank that allows you to download your CSV file, like an Excel of all your transactions. and you can put that into like a pivot table in Excel. Just Google like how to create a pivot table in Excel. And since you have every single expense and everything that came out of that bank account, you'll be able to have a good tally of like, okay, here's how much income I brought in, here's all my expenses. Then you can go in there and because you'll have some expenses that are recurring, mortgage, cleaning costs. You're gonna have like air DNA, right? Like you're gonna have these expenses that are recurring every month, and it's very easy to go in and be like, okay, this is that. Let me categorize it. Boom, that's done. Then you're gonna have some expenses that, oh yeah, the $400, that was when we were at the cabin and we noticed that we needed this, 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 and this, right? So like those are probably good ways to track revenue and expenses.
Okay. And do you generally need to like keep track of your receipts for everything that you're purchasing, or is it enough to kind of just log what you're spending?
We don't, I would say you should keep track of receipts that are material to your business. So like if you bought like an $8 thing at Target, for example, and that was it, like I probably wouldn't hold on to that receipt. But if you bought like 800 $800 thing, I probably would. If it's basically if it's a substantial amount of your revenue, like anything, 3% or more of your revenue, you probably want to have that receipt for audit tax purposes.
Okay.
It's hard to keep every single receipt for every single little thing, but you're gonna want to have the receipts for like the big ticket items.
Got it. Awesome. All right. Let's see. All right. Bella is asking, how about text messages and emails with tenant? Is this, Bella, clarifying question, are you talking about keeping track of this for like for maintenance and like material participation logging?
Yeah, that would be in there in the log.
Okay. So for text messages and emails with the tenant, Ryan, are you like, is it, you're really just need to keep track of the time that you're spending doing that, not really any other kind of metric in relation to that, right?
Yeah, a good time log is gonna have the property, the address, what day, um, how much time did you spend, you know, a summary in there like, oh, I messaged the tenant or I messaged the cleaner, um, and then some sort of uh maybe some sort of proof element too. So for example, like the other week I had to snake a drain at one of my rental properties. So like in the time log I put um had to snake a drain, drove to Home Depot, bought the part, communicated with the tenant that I was going to be in there, and then I attached like the receipt to Home Depot that shows that I bought a drain snake tool or whatever. Yeah. Oh, by the way, too, if you're married and both spouses are doing activities for the property, you want to have in your time log who is doing it, whether it's you or your spouse too. Because both of you are able to track your hours for the material participation.
Okay. Awesome. All right. Last call for any outstanding questions, and then we can wrap up. Ryan, do you want to drop like your site or the community? I know you have a learning community. If folks want to dive in a little bit more.
Yeah, my website is taxstrategy365.com, just like that. You can find me on social media. All handles is my first name, last name, CPA. And then I also, if you're over on school, not like school is in school, but SKOOL .com/taxes. I have a community there for $1 a year. You can get access to all of our um, tools, templates, um, be able to post questions, things like that. So that's just this school.com/taxes.
Awesome. All right. Cool. Those messages were just to host and panelists, so I went ahead and sent that to everyone, Ryan.
Thank you.
Yeah, no problem. Um, awesome. Well, thanks so much, Ryan, for
You're
joining.
welcome.
And we'll be sure to send out that list that Word document that you were going through today. And we'll be sure to share the recording as well.
Yep, you're welcome. No problem.
Awesome. Thanks everyone for joining. Hope you all got some good tidbits out of this and hope to connect soon.
All right,
Thanks.
everybody. Bye for now.
Bye.